Hey guys, Adam Rose, Vice President and Senior Loan Officer for Western Ohio Mortgage here in Sydney, Ohio. And this is another episode of the Mortgage Guy Podcast. And today we're going to talk about OHFA. What is it? People like to use it. People have been inquiring about it. There's a lot of little different options to it and some nuances. It's considered an attachment to your current mortgage or your prospective house or your prospective mortgage. OHFA is the Ohio Housing Finance Agency, headquartered down around the Cincinnati area. And what it is typically used for is for an option for down payment assistance. Down payment assistance, the last couple of years have been getting pretty popular. You could kind of tell. I mean, it's getting advertised everywhere, right? Not just OHFA per se, but a lot of lenders coming out with their own down payment assistance programs, because once that market kind of shrunk up a little bit in 22 and 23, they're trying to find ways to get more buyers into the market and help them out. So OHFA has always been there for a long time. But let's talk about the types of assistance that they have, some of the little nuances to it, how they're a little bit different on requirements and what they need to get their approval. So again, OHFA is Ohio Housing Finance Agency. Types of assistance. So they're going to do two styles of down payment assistance, right? Now this down payment assistance can be used not just for the down payment. So let's say you have enough saved, but you need a little bit in closing costs or something like that. It can be applied for that, okay? So it comes in the form of a silent second. All right, put that in quotes, silent second, because this is a forgivable grant from OHFA, all right? You are not required to pay it back. Now, they have some stuff with that, meaning if there's technically a reimbursement or a recapture. Should you sell the home in the first 9 years, there's a percentage of that second mortgage or that silent second that could be paid back in the form of a tax. Now, they had opened up a reimbursement on the recapture program back in like 2006, and they simply state very few, if any, buyers have ever gotten hit with this recapture tax since they've opened up their reimbursement program. But I would advise, hey, if you have any plans on selling this home in 12 to 18 months, just don't do the program, right? We would suggest that you hang on to it for 4 or 5 years at least to ensure that you get outside that recapture tax should you sell the property prior to the 9-year mark, but just to avoid the recapture. So just an FYI there. It has a little caveat to it. But let's talk about the types of assistance then. So again, we can use it for down payment. We can use it for closing costs. They have two different ones in regards to the amounts. There's a 2.5% assistance and a 5% assistance. Okay. Now, usually when I'm talking to borrowers, there is a 1% origination charge attached to these when we're doing the disclosures. So really, your net benefit to you is 1.5%, 4% when you're doing these OHFA loans through us. Okay. So heads up there. But it might be a great option for you should you come a little short on your down payment requirements or your cash to close. So with these different types of assistance or amounts, they're going to be attached at different rate, which we're not going to talk about rate, okay? But it's attractive. It's a very good rate. It's very competitive for the market. It's not some crazy amount or anything like that. But obviously, the 2.5% assistance is going to have a little bit more attractive interest rate than the 5%, okay? But the three different types that they kind of focus on, they have different tiers of interest rates attached to them, is the straight assistance, okay? You have Ohio Heroes program, okay, which is probably the most attractive rate through all the assistance programs. And then they have the grants for grads, where we're documenting your diploma in the last couple of years, 4-year program or what have you. But those are the three different styles that you can apply for. Now, again, you don't have to be a grant for grad. You don't have to be a graduate. You don't have to be a firefighter, a police officer, a teacher, a nurse, or anything like that to apply. You can get the straight assistance. It's still there. It's still available. The rate's just slightly different. Okay. This is a bond program, so they put those little specialities in there. So those are the types of assistances that you can get. Okay. So qualifying. Let's talk about that. So we go and apply for this assistance. They have a little bit different guidelines, okay? So the first thing is the additional documentation, which you guys have watched these videos before, and you're probably aware of what kind of docs that we need to collect. Specifically, you always remember the 2 years of taxes, or W-2s, right? So with OHFA programs, we have to get a 3 years or 3-year history of your taxes and W-2s for them, not 2. So that's an extra layer of qualifying and documentation required. Credit scores, let's talk about that. So they do all 4 programs, all conforming, right? So they do FHA, USDA, VA, and conventional. FHA financing requires a bare minimum score of 650. The other 3, VA, USDA, conventional, you can go down to a 640. Now, why is this key here? Certain programs, all right, when we run them, they have to be and approve eligible to apply for OHFA financing. If you've watched prior videos, we talk about manual underwriting and how we do that. That's how we were brought up. And it might be a lower credit score bar or what have you, and there's different nuances of the file that can make it either an approve eligible or manual underwrite. In OHFA's eyes, it has to be an approve eligible, okay? So why I say this is important is because with USDA, if let's say you need a down payment closing cost assistance, and that's what we're getting OHFA, I can darn near guarantee you, unless you have a lot of money saved, you are not going to have an approve eligible at a 640 score. Their kind of baseline is 680, and even then it's questionable, right? We got to have some reserves. So it may or may not apply to you for USDA financing, okay? So it's not just you got this score, you're good. You have to have an approve eligible in your findings, okay? So we got that covered. I mean, there's some additional costs involved. Like I mentioned, when we're doing OHFA down payment assistance, we attach a 1% origination charge against that file. So that's what brings down your net a little bit. But there's also homebuyer education classes. So on homebuyer education class, you're going to go directly through OHFA. We'll send you a link. You're going to do this online class. They're going to call you and get you your certificate and then kind of like discuss the class and making sure you're the one that took it. So that's a little piece of it. It takes a little bit of time, but that's also in your disclosures, and it's set up as a $75 fee to the consumer. There are some income limitations as well. So let's talk about that. So we all know, if you watch these videos, we talk about USDA financing a lot. USDA, actually, their income guidelines are more strict than what OHFA with the down payment assistance and the grants are. So again, USDA household of 4 people or less, it's $110,000. Household of 5 people or more, it's like $147,000. But the key here with USDA is it's the household income, right? So even if you're married and your spouse is not on the loan, USDA, I am required to document their income and make sure you're still under their income limits. With OHFA, all right, which again, if you do USDA with OHFA, we have to go with whichever is more strict on the income. Okay, so heads up. But if you're doing FHA, VA, or conventional, let's just go that route for right now, because FHA is probably the most commonly used program mixed with OHFA, in my opinion. But a household of 1 or 2 people, you can go to 111, and a household of 3 or more people, 130. Now, here's the key. You have to be under the income limits for anyone that is on the note, okay? In a nutshell. We have a married couple. Only one is on the loan. The other one is not. With USDA, I have to document both incomes. With OHFA, I only have to document his for the household income. Okay? So they may be combined $120,000, which at USDA, you're out. With OHFA or doing FHA, with OHFA and down payment assistance, he may only have, $70,000 of income. Okay? He's under the limit. So that is key. It's only the income that's on the note or the repayment instrument. Okay? So, and then 2 other little things that go along with OHFA is acreage. Okay? So they're kind of living in old USDA territory. So I remember about 10 years ago, USDA was really strict on large acreage, make sure it's not income producing, and you couldn't split the parcel, right? Because they're concerned about any kind of income producing properties. So we just ran into it, actually, and I completely forgot about the guideline. We had a property, I think it was like 6.2 acres or some weird stuff, and they were going to make an exception for it, but the problem is that we did confirm with the county that this land could be split in half, parceled off, and that other parcel could be sold. OHFA is still following that guideline. Okay, USDA used to do it too, dealt with it all the time, but haven't seen it in years, and they've loosened up a little bit on it. But OHFA's still stuck with it. So heads up, if you're buying a home with OHFA with more than 5 acres, you could potentially have a problem. All right, it's technically not eligible unless you can get an exception made. But if we can confirm through the county that 5 acre parcel plus could be split in half and sold, you're definitely out. All right, so heads up there. That can catch you up as it did myself. And then turn times, right? So when you're doing this financing, we are going to take you from start to finish just like any other loan program. But once we're done with the file and you're practically clear to close on our end, you have to get uploaded to OHFA, all right, for them to review. Well, currently the turn times are about, 8-9 days, business days. They're taking a little while, okay? There's been an uptick in OHFA applications, so they're just getting behind. But you have to be prepared for that, right? If you're doing a 30-day contract on an OHFA loan, you're probably not going to make it, because that means that file is practically clear to close in 18, 19 days in order to make sure you get it to OHFA in time and get it back for a clear to close. That can be a challenge. As we all know, all loans are a little bit different, right? The two things that vary on every loan file is the person and the property. So you never quite know what you might run into. So you want to give yourself a little bit more time on those OHFA contracts just to make sure it gets back in time and you can follow the contract guidance on your closing dates. Those are the main things for OHFA, guys. There's a lot more to it, but I wanted to give you a broad brushstroke on how it operates, some little different nuances. It can be a big benefit to the buyer, and you really just got to compare market rates versus the OHFA rates and what it's looking like that day and make sure it makes sense for you, okay? Like I mentioned earlier, if you're planning on being in the home for a very, very short term or short period of time, I don't really recommend the program. But again, all to their own, right? You can make the decision. We'll give you the options. Very good. So we'll see you all next week, guys. Remember, subscribe on YouTube. Check us out on Apple Podcasts and Spotify, and we will catch you all next week.